So, welcome to part 4 of the AMAC Foundation's online seminar on women and Social Security. As we mentioned last week, this is the final of 4 parts in the series designed to acquaint women with some of the most important facets of Social Security and to provide the information they need to make decisions that are most appropriate to their situation. Just like last week, we need to begin by reviewing our official legal notice, the statement that further defines the information we're going to provide. And let me just read that. The views presented today are provided by the AMAC Foundation Social Security Advisors, certified by the National Social Security Association, LLC. They do not necessarily represent the views of the Social Security Administration. The information presented today does not constitute financial, legal, or tax advice and should be used for information purposes only. Since individual circumstances vary, you should consult your legal, tax, or financial advisors before making any financial decisions. And finally, AMAC Foundation is not affiliated with or endorsed by the Social Security Administration or any government agency. So, with that out of the way, welcome to the 4th part of the seminar on Social Security, where we're focusing on topics of particular importance to women. Last week, we covered a collection of very detailed topics related to benefits for dependents. We delved into the subject of disability benefits, and we concluded with an explanation of the family maximums. It was another long and tedious discussion of Social Security's complex issues and complex rules, and if you weren't able to join us, or if you just want to review that material again, you can watch it via our website, and that's www.amacfoundation.org/videos. The first 2 sessions that we did in this 4-part series are also available at that same location. Okay, now let's move into our 4th and final segment for this seminar. In this part of the program, we're going to focus on several key topics that generate a fair amount of concern for folks planning their retirement. 2 of them address the benefit eligibility of people who may have spent part of their working careers in employment that did not contribute to Social Security, and we'll discuss how those years can affect their benefits. We'll also cover an area that unfortunately catches many people by surprise, and that's the fact that some of their Social Security benefits are likely to be subject to federal income tax. We'll explain the rules that go along with the lump sum benefits available to beneficiaries of estate upon death. We'll close out the session with some guidelines applicable to Social Security beneficiaries living outside of the United States. And finally, we'll touch on the intersection of Social Security and Medicare. So, Sharon, let's begin with an explanation of the Social Security's windfall elimination provision and who it applies to.
Otherwise known as what? Jerry calls it weep.
Yeah, what makes me weep?
If you work for a state or local government agency, including a school system, college, or university, and did not pay into the Social Security program, WEP may apply to you. As you didn't pay Social Security taxes, the estimate shown on your Social Security statement does not account for them. The amount it shows you will receive will be reduced by WEP if you have less than 30 years of substantial earnings in Social Security covered employment. The WEP applies to your own benefit. WEP applies if you have 40 Social Security credits and a pension from a non-Social Security system. You are guaranteed a benefit in this case. You are not affected by WEP if you paid Social Security taxes on 30 years of substantial earnings. Your Social Security statement provides an estimate of your payment without any considerations for the WEP adjustment. The effect of WEP goes beyond your own benefit. Your spouse's and other dependent benefits are also affected. However, the impact of WEP does not affect survivor benefits.
Okay, that's a quick overview of WEP, and Sharon used some terms like substantial earnings that we're going to explore a little bit later. That's key to understanding how WEP ultimately affects you. And now we know who can be affected by WEP, and what benefits can be affected, but exactly how does WEP go about impacting someone's benefits? Let's talk about the actual calculation process and how it takes place.
Well, the provision results in a recalculation of your PIA. PIA, once again, is your primary insurance amount. As a result of your PIA being recalculated and reduced by WEP, all benefits based on your PIA will also be reduced, except for survivor benefits. If your spouse were to survive you, their survivor benefit would be based on your full PIA, even if they receive a survivor pension from your government work. The WEP reduction will be reduced for substantial earnings for more than 20 years and eliminated at 30 or more years.
Okay, and we're going to get into the details of the 20 years and 30 years with some charts and some examples a little bit later. Sharon, some retirees can elect to take a lump sum distribution from a retirement system that did not contribute to Social Security. How's WEP going to handle those kind of situations?
Well, if you decide to take your pension from a non-Social Security covered job in a lump sum, Social Security will recalculate the number of years over which the lump sum would have been spread if it had been received as an annuity. If you outlive the time span determined for the deemed annualization of the lump sum, your PIA will be restored to the pre-WEP level. You can, however, avoid the WEP reduction if you forfeit your right to the government pension before you become eligible for it. You may withdraw the amount you contributed yourself.
Okay, very complicated, but there are some ways to get around it. The issue of who pays into Social Security and who doesn't tends to vary from state to state, doesn't it, Sharon?
Yes, it does. There is, in fact, 15 states where teachers do not contribute to Social Security and who are therefore affected by WEP, and also the government pension offset, known as GPO, which we will get into in a few minutes. And to make it even more complicated, in some of these states, not all school districts are affected.
So when we get a question into the Social Security Advisory Service, that's one of the first things we do. Take a look at where the person's calling from, and then we take a look at the individual state and what the rules are in the states. And, you know, we need to do that in order to provide them the correct advice. Okay, that's for school teachers, but let's talk a little bit about other types of government workers.
There are state, county, municipal, and special district employees in 27 states that are affected by WEP and GPO. In these states, just like for school teachers, there is an impact on their Social Security benefits as a result.
And unfortunately, for many of the people that call into our service, they are not really aware of what the WEP impact is on their Social Security benefits, and it causes a lot of concerns and a lot of frustration. But the numbers are the numbers, so we just give them the best advice we can. Sharon, let's talk a little bit now about a confusing point on WEP, and that's exactly how the effect on Social Security benefits is calculated. Let's take a minute and run through some numbers that might help explain this, beginning with the original formula for calculating PIA. You have to start there, and we discussed that way back in session number 1, and so that becomes the basis for the WEP adjustment.
Okay, until you actually run through a calculation, it can be a little hard to understand. First, let's review how a basic PIA is calculated. As shown on this slide, it's actually a 3-step process involving segments of your average index monthly earnings, known as AIM. The WEP impact involves the change to the first segment bend point, with the percentage reducing based on the number of years without substantial Social Security earnings. For example, someone working in a government job and who has never had substantial earnings from Social Security government employment would see their first bend point, the segment comprising 90% of their PIA, reduced from 90% to 40%. As you can see, this would significantly reduce the part of their PIA calculation. It's also important to note that the WEP reduction can't be more than 50% of your total pension, so this calculation may be overstated.
I just want to reiterate, Sharon, that's where the real impact of WEP is in that very first bend point, because you can see in the formulas that awarding 90% of that first segment of earnings in your history is where Social Security is weighted to low-income people. And so if that 90% gets reduced to 40% as a result of working in non-covered employment, you can see that it makes a pretty significant impact on the benefit, because that's where most of the basic benefit comes from.
Yes, and also for every year you have substantial earnings beyond that 20 through 30 years, that reduction is reduced by 5%.
Right. So we've been kicking this substantial earnings term around a little bit, and that's a factor that can result in a reduction of the impact that WEP has on Social Security benefits. Exactly what does that term mean, Sharon, and how is it used in the WEP reduction process?
Well, as I mentioned in an earlier slide, the impact of WEP reduction will be reduced for substantial earnings of more than 20 years and eliminated with 30 or more years. In other words, if a worker has Social Security covered earnings exceeding a specific amount for specific years, the WEP formula allows for the reduction to be trimmed. For example, this year, 2018, Social Security covered earnings exceeding $23,850 would reflect a year of substantial earnings. For workers having more than 20 years of substantial earnings on their record, each year above 20 reduces the WEP impact, and if that worker has more than 30 years of substantial earnings, the impact of WEP is eliminated. And this is another large area of confusion, because people are not aware that they have to earn a certain amount each year.
Right. Right. A lot of, particularly school teachers, take second jobs and summer jobs. And I think it gives them the impression that it's going to remove the WEP penalty on them, but it really doesn't unless it exceeds those substantial earnings levels. So that's something that, we take care to make sure people understand that. Okay, that was WEP, the Windfall Elimination Program. Let's shift gears a little bit now and talk about the other part of this particular area. That's Social Security's government pension offset. That's another provision, and let's talk about who that applies to.
Well, if you receive a government pension from non-Social Security covered work, the GPO may reduce your Social Security benefit payable as a spouse, a divorced spouse, a surviving spouse, or a surviving divorced spouse.
Okay, so the main difference between WEP and GPO is that WEP affects the worker's earnings and GPO affects the spouse's benefit. Sharon, let's take a look now at how this GPO reduction is actually calculated.
Well, under the GPO, the Social Security Administration reduces your benefit by $2 for every $3 you receive from your government pension. For example, let's consider someone is eligible for a spousal benefit of $500, and they will also receive a government pension of $600 per month. The way the math works is the $600 is subject to the 2/3 reduction, bringing it down to $400. As a result, the spousal benefit becomes 100 instead of 500. They take the 600 times 2/3, which equals 400, and they take the 500, subtract that $400 reduction, which results in $100 spousal benefit. This is called a partial GPO offset, but unlike the WEP reduction, the GPO reduction can actually reduce your spousal or survivor benefit to 0. This is called a total GPO offset. Taking a lump sum benefit when you retire will not stop the GPO. The Social Security Administration will determine how much the government pension would be if it were paid monthly, and then reduce your monthly benefits.
So there really is no way to escape it. And, in that last comment Sharon made, it becomes an annuitization process going forward, and they're still going to reduce the spousal benefit. Sharon, aren't there some ways a spouse can have the GPO impact lessened?
Well, there is a way to get out from under the GPO. You can stop your Social Security benefit from being subject to GPO by working 5 years, equal to 60 months, in a position that pays into the same retirement system, but also pays into Social Security. During this time, you cannot work so much as 1 day in a non-covered Social Security position. If you do that, they won't count the month. If you have already retired, you would have to give up receiving your pension and go back to work under the same pension plan and pay into both systems. You only need to work at least 1 day per month for a total of 60 months.
But unfortunately, the kicker that people find unacceptable is that you do have to give up receiving your pension, and people find that very hard to do. So that concludes our discussion on WEP and GPO. And I have the chat window open, so if anybody has any questions about that, or if you'd like us to recover any points on that, just send us a quick note and we'll deal with that question as soon as we get it. Let's move into an area now that causes a lot of frustration for retirees. This issue of income taxes applied to Social Security benefits. Many folks aren't aware that there's a strong possibility that they'll end up with a tax bill when they begin drawing benefits, depending on how much other income they receive. This is a shock to many, many people, and it always raises the cry of double taxation, since in order to receive benefits, one must already have paid into Social Security, must already have paid Social Security taxes, I should say, during their working years. And so now, when they're drawing a Social Security benefit, to pay income tax on that just really, really becomes a frustration for Social Security beneficiaries.
Yes, we do get quite a few inquiries about this from new Social Security beneficiaries. Generally, if Social Security is your only income, your benefits are not taxable, and you probably don't have to file a federal income tax return. But if you collect other income in addition to Social Security, you could owe taxes on at least a portion of it. Your Social Security benefit may be taxed if you earn income from other sources and your modified adjusted gross income exceeds the base amount for your filing status. When determining how much of your benefit is taxable, your adjusted gross income is adjusted to include items previously excluded from federal income tax calculation purposes, resulting in a modified adjusted gross income figure. Social Security refers to this new figure as provisional income, and it determines how much of your benefit is taxable at your federal rate.
So when we're dealing with someone that has contacted our advisory service, and first of all, they're frustrated when they realize that there is an income tax obligation. And then when we get into explaining how you calculate the modified adjusted gross income, it gets even more frustrating for them, because when they're doing their income tax return, there are things that get excluded from adjusted gross income that basically lowers their tax burden, but now they've got to be added back in order to calculate the rate that they're going to pay on their benefit. And that just becomes another area of frustration.
Yeah, and as shown on this slide, they include the following income: half of self-employment tax, student loan interest, tuition and fees deduction, and qualified tuition expenses, passive income loss and rental losses, IRA contributions and taxable Social Security payments, exclusion for income for U.S. savings bonds, exclusion for adoption expenses, and tax exempt interest.
Yeah, and once again, the frustrating thing here is these were all items that have been taken out of the normal income tax calculation, the income tax liability calculation, but now they've got to be added back in to calculate the portion of Social Security that's going to be taxable. Sharon, now that we know what our provisional income is, how is that used to determine how much of the Social Security benefit actually gets taxed?
Well, it depends on your filing status, and as the slide shows, it's a tiered process. For single filers with modified adjusted gross income less than $25,000, nothing is taxable. For single filers with modified adjusted gross income between $25,000 and $34,000, 50% of the benefit is taxable, and so on. For married filings, individuals filing separately and they did not live together at any time during the zero for a married person filing separately that lived together at any time during the year. And Social Security will withhold federal income taxes from your benefit payments upon your request. It is not, you can select a percentage withholding amount of 7, 10, 15, or 25%. You can request withholding when you apply for your benefits, or if you change your mind later, you can file IRS Form W-4V. It is available on www.irs.gov, or you may call and request one to be mailed to you. This you would then mail to your local Social Security office, not to the IRS.
This is where a lot of the frustration from our callers comes in, because they've gone on Social Security and they were not advised of the issue of taxation, and so therefore they haven't had any income tax withheld from their Social Security benefit. Now all of a sudden, going through the calculation at tax time, they find out they have a tax liability, and that's when it really becomes an issue. As Sharon mentioned earlier, if Social Security is your only income, then it's likely that you will not have a tax liability. And if you look at that chart, you see that for married filing jointly, income of modified adjusted gross income of less than $32,000 produces no tax liability. And if the average Social Security benefits for two fully insured beneficiaries are about $16,000, then you can see that combined will stay under $32,000 or right around $32,000. So that's why we say if Social Security is your only income, then you typically do not have a tax liability. But as soon as you go above that, then the first tier is at 50%. Is going to be subject to tax, and then once you get above $44,000, for example, if you have a pension on top of Social Security, or you're taking IRA distributions or 401k distributions, you're very quickly going to get above $44,000 as a married couple, and that's when you're up to 85% of your benefit becomes taxable, and that's where the frustration comes in for a lot of people, and that's where we hear about the double taxation.
Right, and those tax calculations do not include a Roth IRA or a Roth 401k,
right,
because you've already paid the taxes.
Right. Yeah, this is all the pre-tax, with the pre-tax income coming in. Okay, that covers the issue of taxation of benefits. Again, it's not a very friendly topic for us to deal with, but we get a lot of calls about it. Sharon, one of the questions our advisory service quite often fields involves this thing called the lump sum death benefit that's provided by Social Security. Some people wonder about the amount, some wonder who is eligible to receive it, and some are just wanting to clarify something they've been told by a friend or a neighbor. And let's take a moment and just kind of clarify this topic.
Well, here's how it works. A surviving spouse or child may receive a special lump sum death benefit payment of $255. The lump sum benefit is usually paid to the surviving spouse that was living in the same household with the worker when they died. If they were living apart, the surviving spouse can receive the lump sum payment if during the month the worker died. If they were already receiving benefits on the worker's record, they became eligible for benefits upon the worker's death. If there is no eligible surviving spouse, the lump sum can be paid to the worker's child or children if during the month the worker died. If they were already receiving benefits on the worker's record, they became eligible for benefits upon the worker's death. If the eligible surviving spouse or child is not currently receiving benefits, they must apply for this payment within 2 years of the date of death.
Okay, I hope that clarifies it for everybody in terms of the lump sum death benefit. It does come up frequently with people that just are not clear on the rules. I want to move into another topic. We did get a question from Stephanie, and I see, I believe it was a question that we've already answered. Would modified adjusted gross income include withdrawals from IRAs? So I think from the previous chart, that question's been addressed, but you want to?
Yes, it would, unless it is a Roth IRA.
Right. Okay. Moving on to the lump sum death benefit issue into another topic that is becoming sort of a trend these days. If you read a lot of the popular press, you hear a lot about people moving out of the United States and retiring abroad, and raises a lot of questions about how they collect their Social Security benefits offshore. There are some rules that go along with this, and so let's talk about some of the specific rules that govern this option that people seem to be exercising more and more these days.
Well, if you are a U.S. citizen, you may continue to receive payments outside the United States as long as you are eligible for payment and you are in a country where Social Security can send payments. If you are not a U.S. citizen, you must meet one of the conditions for payment. When Social Security says you are outside the United States, they mean you are not in one of the 50 states, the District of Columbia, Puerto Rico, the U.S. Virgin Islands, Guam, the Northern Mariana Islands, or American Samoa for at least 30 days in a row. Social Security considers you to be outside of the United States until you return and stay in the United States for at least 30 days in a row. If you are not a U.S. citizen, you also may have to prove you were lawfully present in the United States for that 30-day period. Your Social Security benefits are calculated in U.S. dollars. Social Security does not increase or decrease your benefits because of changes in international exchange rates. Also, it's important to note that the U.S. Department of the Treasury prohibits making payments to persons residing in Cuba or North Korea. If you are a U.S. citizen residing in Cuba or North Korea, you can get all the payments Social Security withheld once you move to a country where they can send payments. Under the Social Security Act, if you are not a U.S. citizen, you cannot receive payments for the months you lived in Cuba or North Korea, even if you go to another country and satisfy all other requirements. In addition to those two countries, generally Social Security payments cannot be sent to a person in any of the other countries listed above. However, exceptions can be made for certain eligible persons in these countries. If you do not qualify for an exception, Social Security will withhold your payments until you leave the country with Social Security restrictions and go to a country where we can send payments. If you are not a U.S. citizen or you do not meet one of the conditions for continued payments, Social Security will stop your payments after you have been outside the United States for 6 full calendar months. Once this happens, Social Security cannot restart your payments again until you come back and stay in the U.S. for a full calendar month. Social Security may ask you to prove you have been lawfully present in the U.S. for that full calendar month, which goes from the first minute of the first day to the last minute of the last day. To determine whether you meet the conditions for continued payments while you are outside the United States, use the Payments Abroad screening tool. Actually, I'm going to add the screening tool. Okay. If anyone needs this, I will give you this website address. It is https://www.ssa.gov/international/payments.outside-us.html.
Or another simpler way to do it, I think, would be just go to ssa.gov and in the search panel, enter Payments Abroad screening tool, and they'll take you right to it.
That would work too.
Yeah.
If you are not a U.S. citizen or you are not permanent resident of the United States, Social Security will withhold a 30% federal income tax from 85% of your benefit amount, unless you meet the conditions of an income tax treaty that reduces your tax rate. This results in 25.5% withholding of your monthly benefit amount. You can use the Alien Tax Screening tool to help you determine if your benefits are subject to this non-resident alien tax withholding, or if you qualify for a tax treaty benefit. That Alien Tax Screening tool is also available on the Social Security website.
Yeah, just go to the site and enter in the search panel Alien Tax Screening tool, and they'll take you right to it. The interesting thing about all that is a lot of complex rules and a lot of overlapping rules, but the interesting thing is you hear a lot of people say, well, I'm just going to live abroad, they'll send me my check, easy. Well, it's not that easy, so it just depends where you live.
Check with where you're moving to make sure you can get your benefits in that country before making that move.
Yeah, as with most things, Social Security and government in general are related. It's just not as easy as it sounds sometimes. Okay, Sharon, let's wrap up today's session with a quick discussion concerning some Medicare issues that we get a lot of inquiries about at our Social Security Advisory Service, beginning with Medicare's hold harmless provision. And that, of course, is something that has been in the news a lot over the past few years because of its impact on the cost of living adjustments for Social Security benefits. We got a lot of inquiries at the beginning of this year for people that were expecting a 2% adjustment in their Social Security benefit and wound up getting $1.50 or something.
I'm still getting phone calls.
Yeah, so we're still getting calls on it. And so we're going to explain what that means and how that happens.
Okay, the Social Security Act contains what is known as a hold harmless provision, which essentially states that your Social Security benefit payment cannot decrease due to an increase in Medicare's Part B premium. This is an important provision because Medicare costs tend to rise annually, often resulting in higher Part B premiums. However, to be protected by this provision, your Medicare Part B premiums must be automatically deducted from your Social Security benefit payments, and about 70% of all Social Security beneficiaries enjoy this hold harmless protection. If your Medicare Part B premium is not automatically deducted from your Social Security benefits, you will be subject to paying the standard Part B premium. The Medicare Part B premium is also affected by your annual income and income tax filing status. If you switch from one Social Security benefit to another, example, from your own benefit to spousal benefits, from survivor benefits to your own benefit, or from spousal benefits to your own benefit, etc., you are subject to your Medicare Part B premium amount being increased to the most current standard Part B premium amount. The same rule that protects you from having your benefit reduced when there is an increase in Medicare Part B, but no COLA increase, also allows for your COLA increase to be used to partially or entirely be offset by an increase in the Medicare Part B premium. And this is what most recipients experienced last year if their benefit wasn't at least $1,250 per month.
Right. And it caused quite a bit of concern and inquiries to our service. Okay, Sharon, another aspect of Medicare that higher income beneficiaries need to understand is something called IRMA. We use the term IRMA, but what it means is income related monthly adjustment amount. It ends up being a sort of surtax for a portion of the Medicare population, doesn't it?
Yes, it affects the people with higher annual earnings. The income-related monthly adjustment amount, or IRMA, is an additional amount that you pay for your monthly Medicare Part D prescription drug plan premiums and your monthly Medicare Part B, which is outside patient or doctor visit coverage premiums. So IRMA is an additional amount added to the monthly Medicare Part B and Part D premiums for individuals whose modified adjusted gross income exceeds certain threshold amounts that can change each year. As noted by CMS under 1839I5 of the Social Security Act, the dollar amount for the income tiers will be adjusted annually based on the Consumer Price Index. However, in accordance with 3204 of the Affordable Care Act, these income threshold amounts will remain at the 2010 levels for calendar years 2011 to 2019. And as noted by the Social Security Administration, if you have higher income, the Medicare law requires an adjustment to your monthly Medicare Part B and Medicare prescription drug coverage, known as Part D. Higher income beneficiaries pay higher premiums for Part B and prescription drug coverage. This additional premium cost affects less than 5% of people with Medicare. So most people do not pay a higher premium.
Okay, but it does catch those with really high incomes that are on Medicare. Sharon, let's take a quick look at the income levels that you just discussed and the Medicare premium payments that are related to them. Just a quick run through some of the examples.
Okay, the above Medicare premiums apply if you enroll in Part B for the first time in 2018. You don't get Social Security benefits. You're directly billed for your Part B premiums. You have Medicare and Medicaid pays your premiums. Your state will pay the standard premium amount of $134. Your modified adjusted gross income, as reported on your IRS tax return from 2 years ago, is above a certain amount. If so, you'll pay the standard premium amount and an income-related monthly adjustment amount. IRMA is an extra charge added to your premium. Yes, unfortunately, Social Security receives your tax returns almost 2 years later. And there are instances where you can contact Social Security to get out of that higher premium. But as you can see, for married, once you go over 170,000, it increases to 187.50 and continues on up.
Okay, but again, that whole provision only affects roughly 5%
Right.
of the population. So, okay, it's a kind of complicated adjustment process, but that's the way the law is written currently. Okay, that concludes part 4 of our Women in Social Security workshop. As we mentioned earlier, all the sessions have been recorded and are available on the Foundation's website. Just go to www.amacfoundation.org and click on the Videos tab, and you'll see, right now you'll see the first 3, and we'll have the 4th one up probably by tomorrow. And you can watch them in their entirety. If you have any questions about the topics we've covered, just give us a call at the Foundation office, and that number is 888-750-2622, and we'd be happy to help you out with any questions you have. Or you can send us an email to ssadvisor@amacfoundation.org. Again, we'd be happy to help you answer your questions about this fascinating world of Social Security.
Yes, it is.
And with that, we will end our webinar. And again, any questions, just get in touch with us. Thank you very much and have a good day.